The silver market did not ease into volatility, it was thrown into it. Prices moved with speed and force, dropping sharply before reversing just as aggressively, creating a sequence that felt less like routine trading and more like a stress event. The sudden plunge and rebound exposed how thin stability becomes when confidence is tested, and reactions compress into hours rather than days. This was not a slow recalibration. It was a rapid collision between expectations and reality. As prices fell, the move carried a sense of disorder. The decline was deep enough to unsettle participants who believed the market had found firmer footing. Almost immediately, the reversal challenged that assumption again, suggesting that neither side of the trade held lasting control. What emerged was not clarity, but tension. Each price print seemed to contradict the last, reinforcing the impression that the market was operating under strain rather than direction. This sequence matters because it reframes how the silver market is being experienced. Volatility here was not confined to charts or technical levels. It translated into uncertainty about liquidity, positioning, and the reliability of price discovery itself. When prices can fall hard and rebound just as fast, the market begins to feel less like a mechanism for valuation and more like a system reacting to pressure from multiple directions at once. The initial plunge and surge set the tone for everything that followed. It established that recent trading was not just about supply and demand in isolation, but about how quickly narratives, rules, and expectations can shift. The market's behavior suggested sensitivity rather than resilience, as though it were responding to shocks rather than absorbing them. In that environment, every subsequent development carried more weight, because the foundation had already shown signs of instability. The depth of the move made it impossible to dismiss as routine fluctuation. Silver fell to levels that immediately widened the gap between where prices had been and where they suddenly stood, creating what was described as a massive spread. This was not a gradual slide, but a sharp displacement, one that forced participants to reassess positions in real time. The speed of the decline compressed decision-making and magnified its psychological impact. As the price rebounded toward the upper end of the range, the spread itself became the story. The distance between the low and the rebound illustrated how quickly value was being reassigned. Such a swing signaled that liquidity was uneven, with moments where selling pressure overwhelmed bids, followed by phases where buying rushed back in just as aggressively. The market appeared to be snapping between extremes rather than settling into equilibrium. This kind of movement exposes fragility in the pricing process. When spreads expand this quickly, it suggests that the market is struggling to reconcile competing pressures. Sellers are acting with urgency, while buyers are either stepping back temporarily or re-entering all at once. The result is not smooth discovery, but abrupt repricing that leaves little room for stability in between. The rebound itself did not resolve the uncertainty created by the drop. Instead, it reinforced it. A rapid recovery after such a fall can signal confidence, but it can also indicate that prices are being driven by reactive flows rather than firm conviction. In this case, the swing from low to rebound underscored how sensitive the market had become, where sharp declines did not deter participation, but instead triggered equally sharp reversals. By highlighting this spread, the market revealed its own tension. The range was not just a statistic, it was evidence of strain beneath the surface. Each extreme pointed to different fears and assumptions colliding at once. Rather than calming conditions, the movement emphasized that silver was trading in an environment where stability was fleeting and price levels could be challenged and reclaimed within the same breath. As prices moved violently, external narratives quickly took hold, adding another layer of instability. Fears around potential import tariffs began circulating through the market, injecting uncertainty at a moment when prices were already under pressure. These concerns did not need to be confirmed to have an effect. The mere possibility was enough to alter behavior, as participants tried to anticipate how policy decisions might reshape costs and access. Clarification arrived when it was stated that precious metals such as gold would not be subject to tariffs. On the surface, this should have reduced anxiety. Yet the market response showed that reassurance alone was not enough to restore calm. Volatility had already been unleashed, and the clarification did little to reverse the broader sense that policy risk remained unresolved. The reaction underscored how quickly markets can internalize fear, even when official statements attempt to contain it. Once uncertainty enters the system, it tends to linger. Traders and investors do not simply reset their expectations. They begin to question what might still be excluded or left ambiguous. In this case, the confirmation regarding gold did not fully settle concerns about other metals. Geopolitical tension amplified this dynamic. Headlines and speculation blended together, making it difficult to separate concrete policy from perceived risk. In such an environment, price moves become less about verified outcomes and more about positioning ahead of unknowns. The silver market reflected this shift, reacting not just to facts, but to the space between what was clarified and what remained uncertain. Rather than stabilizing the situation, the tariff discussion layered additional complexity onto an already volatile market. It highlighted how interconnected silver pricing is with political and policy narratives. Even when certain fears are addressed directly, the residual uncertainty can continue to influence behavior. The result was a market that remained sensitive, with price action reflecting ongoing unease rather than renewed confidence. Even with assurances that some precious metals would be spared, attention turned to those still exposed to uncertainty. Silver and the platinum group metals remained vulnerable because of their industrial roles, keeping them tied closely to policy and trade considerations. This distinction mattered. Unlike metals viewed primarily as monetary assets, these materials sit at the intersection of finance and production, making them more sensitive to disruptions in trade frameworks. The market response reflected this sensitivity. Participants did not treat the clarification as a blanket resolution, but as a partial one. The industrial importance of silver meant that questions about tariffs and trade policy continued to hover over pricing, regardless of statements addressing other metals. That lingering exposure kept volatility elevated and prevented confidence from fully returning. This dynamic reinforced the idea that silver occupies a complex position. Its valuation is influenced not only by investment demand, but also by its role in manufacturing and technology. When policy uncertainty touches industrial supply chains, silver becomes a focal point, absorbing anxiety that might otherwise be spread more evenly across markets. As a result, concerns surrounding silver and related metals persisted even after the initial tariff fears were moderated. The market remained alert to the possibility that industrial considerations could trigger further adjustments. That vigilance translated into continued price sensitivity, where movements were shaped as much by anticipation as by confirmed developments. The distinction between metals that were clearly exempt and those that were not created an uneven landscape. Confidence stabilized in some areas while remaining fragile in others. Silver sat firmly in the latter category. Its industrial relevance ensured that policy uncertainty continued to exert pressure, reinforcing the volatility already present and setting the stage for further developments that would test how the market manages risk under shifting rules. Against this backdrop of heightened sensitivity, changes introduced by the CME Group took on outsized significance. The first adjustment involved moving silver futures margin rates to a floating structure tied directly to price. Rather than remaining fixed, margins would now adjust as prices moved, altering the cost of holding positions in real time. In a calm market, such a change might have gone largely unnoticed. In a volatile one, it immediately reshaped risk calculations. Floating margins introduce a dynamic form of pressure. As prices rise or fall, the capital required to maintain exposure shifts alongside them. This can amplify reactions during sharp moves because participants are forced to respond not only to price changes, but also to evolving collateral demands. In the context of recent swings, the rule change reinforced the sense that stability was being replaced by continuous adjustment. The timing mattered. Implementing structural changes while prices were already unstable added to the perception that the market was being redefined mid-movement. Participants had to adapt on the fly, recalibrating strategies under new conditions rather than operating within familiar constraints. This contributed to uncertainty, as past assumptions about margin requirements could no longer be relied upon. Such changes also influence behavior beyond individual trades. When margin requirements float with price, they can discourage some forms of participation while pressuring others to reduce exposure more quickly. This can thin liquidity at critical moments, increasing the likelihood of abrupt price moves. In an environment already marked by sharp drops and rebounds, the effect was to heighten awareness of how rules interact with volatility. The shift to floating margins underscored a broader theme emerging in the silver market. Pricing was no longer being shaped solely by supply, demand, or sentiment, but by evolving frameworks governing how risk is managed. As those frameworks change, so does the character of the market itself. The adjustment signaled that participants were now operating in a landscape where costs and constraints could move as rapidly as prices, reinforcing the sense of fragility that had defined recent trading. Alongside the change in margin structure, the CME Group introduced a second adjustment that further altered the landscape of silver trading. A new 100-ounce silver futures contract was announced, distinct in both scale and settlement method. Unlike traditional contracts tied to physical delivery, this instrument would be settled in cash. That distinction carried important implications for how exposure could be gained and managed. Cash settlement changes the relationship between futures pricing and physical metal. By removing the requirement for delivery, the contract allows participants to take positions without any direct connection to supply logistics. In periods of stability, this can increase flexibility. In periods of stress, it can deepen the divide between paper pricing and physical availability. The introduction of such a contract during heightened volatility drew attention precisely because of that separation. The smaller contract size also mattered. At 100 ounces, the barrier to entry was reduced compared to larger instruments, potentially broadening participation. At the same time, easier access does not guarantee smoother markets. When combined with cash settlement, it can increase the volume of activity that responds purely to price movement rather than underlying conditions in the physical market. This change reinforced the sense that trading mechanics were evolving in ways that could influence behavior quickly. Participants now had another tool that emphasized price exposure over physical connection. In an environment already marked by sharp swings and uncertainty, the new contract added complexity rather than simplicity. Together with floating margins, the introduction of the 100-ounce cash-settled contract highlighted how structural decisions can shape market dynamics. These were not neutral adjustments. They altered incentives and responses at a moment when the silver market was already under strain. The result was a trading environment where paper mechanisms took on greater prominence, even as questions about physical supply and liquidity were becoming more acute. As attention focused on evolving paper structures, concerns around the physical market began to surface more clearly. The discussion shifted toward liquidity in the global silver supply, with particular emphasis on conditions in London and China. Reports pointed to dwindling availability, raising questions about how easily physical metal could be sourced as demand and volatility increased. These concerns did not emerge in isolation. They followed directly from the sharp price movements and the changes in trading mechanics. When paper instruments expand while physical availability tightens, the contrast becomes harder to ignore. The market began to reflect this tension, with awareness growing that liquidity in physical channels was not as deep or flexible as pricing might suggest. The situation in major hubs added weight to these concerns. London, long a central node in precious metals trading, and China, a key participant in global flows, were both cited as facing tighter conditions. This combination amplified unease because it suggested that constraints were not localized but spread across critical points in the supply network. Liquidity issues have a compounding effect. When availability tightens, participants become more cautious, and that caution can further reduce the willingness to transact. In a volatile environment, this feedback loop can intensify price sensitivity, as even modest shifts in demand or supply have outsized effects. The silver market appeared to be entering such a phase, where perceptions of scarcity mattered almost as much as actual inventory levels. By bringing physical liquidity into the conversation, the focus moved beyond price charts and contracts. It raised fundamental questions about how the market functions when physical supply is under pressure. The contrast between expanding paper options and tightening physical channels underscored a growing imbalance. This imbalance did not resolve volatility, it deepened it, reinforcing the sense that the silver market was operating under multiple layers of strain simultaneously. Attention then turned to China, where new export restrictions added another layer of uncertainty to an already strained environment. Initial reactions framed these measures as a potential cutoff, raising fears of a sudden disruption in global supply. Given China's role in the silver market, such interpretations carried immediate weight, feeding into concerns about tightening availability and future access. Clarification followed, emphasizing that the measures were not an outright ban, but a tightening of licensing and management procedures. This distinction mattered, yet it did not fully neutralize the impact. Even stricter administrative control can slow flows, introduce delays, and increase uncertainty for participants who rely on predictable movement of material. The market absorbed this nuance cautiously rather than with relief. The response highlighted how sensitive conditions had become. In a calmer setting, a clarification might have settled nerves. Here, it instead reinforced awareness that supply chains were being placed under closer supervision. The difference between prohibition and restriction was technical, but its implications were practical. Any added friction in exports was enough to keep concerns elevated. This development also interacted with the broader narrative of tightening liquidity. When physical supplies are already perceived as thin, even incremental controls take on disproportionate significance. The market did not need confirmation of a full halt to react. The acknowledgement of stricter oversight was sufficient to sustain unease. By framing the issue as management rather than prohibition, the clarification provided context, but not certainty. Participants were left to weigh how licensing changes might translate into real-world availability. In that ambiguity, caution prevailed. The discussion around China's export controls thus became another element reinforcing instability, adding to the sense that the physical side of the silver market was becoming more constrained and less predictable. Confusion surrounding a major bullion dealer then became a focal point, illustrating how quickly misinterpretation can ripple through an already tense market. An announcement from APMEX was initially understood as imposing a minimum requirement for retail purchases, suggesting that buyers would need to meet a high threshold to acquire silver. This interpretation spread rapidly, feeding the narrative that access to physical metal was becoming restricted. The clarification changed the picture, but did not eliminate concern. The minimum was not for purchases, but for buybacks. Customers seeking to sell silver back to APMEX would need to transact at least $10,000 worth of metal. While this correction removed the idea of a direct barrier to buying, it introduced a different implication, that liquidity on the dealer's side was under pressure. A buyback minimum of that size signaled strain rather than convenience. It suggested that handling smaller transactions was becoming less desirable or less feasible under current conditions. In a market already sensitive to signs of stress, this adjustment was interpreted as evidence that operational realities were tightening behind the scenes. The episode underscored how fragile confidence had become. Even a misunderstanding was enough to move sentiment because participants were primed to expect restriction. The need for a correction did little to calm nerves, as the revised explanation still pointed toward unusual measures being taken within the physical market. Rather than closing the issue, the APMEX clarification deepened the sense that normal conditions were no longer in place. It reinforced the idea that bullion dealers were adapting to pressures that were not immediately visible in headline prices. In this context, the distinction between buying and selling mattered less than the broader signal being sent. The market read the change as another indication that the system was under stress and that adjustments were being made to manage that strain rather than eliminate it. The discussion ultimately turned forward toward what these developments implied rather than what they had already produced. Despite the sharp swings and the signs of strain, the outlook presented was not one of collapse, but of absorption. Short-term downside was acknowledged as a possibility, yet it was framed as something the market could take in rather than be broken by. Volatility, in this view, was not an endpoint, but a process. The expectation was that selling pressure, when it appeared, would meet a market prepared to respond. The rapid rebounds already seen were taken as evidence that demand had not retreated, even under stress. Instead of signaling exhaustion, the turbulence suggested active engagement, where declines were met with renewed interest rather than abandonment. This perspective rested on the idea that the forces driving silver had not been resolved or reversed by recent events. Structural changes, policy uncertainty, and physical constraints had introduced instability, but they had not removed participation. If anything, they had intensified attention. In such an environment, downside moves were seen less as trend reversals and more as tests of conviction. The conclusion drawn was measured rather than euphoric. The market was not portrayed as immune to setbacks, nor were risks dismissed. Instead, the emphasis was on resilience. The ability of prices to recover quickly, even after sharp drops, suggested that pressure was being redistributed rather than released. From this angle, the broader move in silver was described as unfinished. Volatility and rule changes had altered the landscape, but they had not closed the chapter. The bull run, according to this outlook, remained intact, not because conditions were calm, but because instability itself had become part of the mechanism pushing the market forward.